Welcome to another session in the series of financial management lectures. I am Dr. Neha Seth and I am working in the capacity of Associate Professor with School of Management Studies, Indira Gandhi National Open University. And today we are going to discuss leverage analysis and EBIT-EPS analysis in this session. So, to start with leverage analysis, it has this word called leverage. So, before moving ahead, let us understand the meaning of leverage. So, leverage, if I will say in the very simpler terms, leverage means utilizing our resources in such a manner that we are able to achieve the desired outcome. How efficiently we are using our available resources. So, when it comes to financial leverage or leverage in terms of finance, we are talking about the resource which is known as debt. How well we are using this source of finance called debt so that we can achieve the desired outcome. Leverage in financial terms also means the relationship between two interrelated variables, two variables in which one is independent and another is dependent. How the independent variable is changing and how it is affecting the dependent variable. This responsiveness, this relation of one variable over another variable is called leverage. Now, when I am talking about independent and dependent variable, so in terms of finance I may talk about the sales and the profit. So, sales may be the independent variable, okay, which is taking place as per the market need, and the profit which is dependent variable which is dependent upon sales. How the profit is changing when the sales is changing. Okay. This is what we are going to understand with the help of this term called leverage. So, when we are talking about leverage in terms of finance, we have this small equation or the formula which represents leverage. So, leverage is percentage change in dependent variable divided by percentage change in independent variable. In my example, I just now said that how our profit is changing or reacting according to change in sales. So, this we can calculate in finance. To understand this in a more better or clearer manner, we should understand the relationship between sales and profit. So, we are extending the same example and our leverage is categorized into three parts in finance. One is operating leverage, second is financial leverage and third is combined leverage. So, what is operating leverage? On the screen on left hand side of the table, you can see that how operating leverage is calculated or how it works. So, we start our calculation with the sales. Okay. Out of sales, we have to deduct variable cost. Once we will deduct variable cost from the sales, we will get the value of contribution. After subtracting fixed cost from the contribution, we will get operating profit, or we may call it profit, or in financial terms we call it EBIT, that is earning before interest and tax. So, this process where we have started from sales and we are able to calculate the profit, this process is called operating leverage. Okay. This is how we calculate operating leverage, that means change in profit according to change in sales. On the right hand side of the table, you can see that EBIT is taken and from EBIT we are subtracting interest. So, when we are subtracting interest from EBIT, we get earnings before tax, we may also call it profit before tax. Now, we subtract tax from this and we get earnings after tax. Okay. So, this process of calculation of earnings after tax from EBIT is called financial leverage, because this is showing the impact of utilizing or using debt in our financial pattern. Okay. And when we are combining these two types of leverages, operating leverage and financial leverage, we get the value of combined leverage. We call it combined leverage. There is one more small thing that we are going to use when we will move further in this session today, that is calculation of EPS, earnings per share. So, earning per share may be calculated by dividing our EAT, earning after tax, by number of equity shares in your capital. So, coming to the first type of leverage, operating leverage. So, operating leverage affects a firm's operating profit. Operating profit means our EBIT. Okay. The degree of operating leverage is defined as the percentage change in earnings before interest and tax in relation to or relative to a given percentage of change in sales. So, if I want to represent this operating leverage in terms of a formula, the formula would look like this. The degree of operating leverage is equal to percentage change in EBIT divided by percentage change in sales. Okay. So, this may also be calculated like this, where change in EBIT divided by EBIT, exact value of EBIT, which will further divided by change in sales upon sales. So, we can use either of these formula for calculating operating leverage. Now, let us try and understand the concept of operating leverage with the help of this example, wherein we have this value in the second column of present sales or the present condition, where we are about to sell 1000 units, and in another column, the extreme column on the extreme right, which shows the expected level of sales that we want to achieve, that is 1400 units. Okay. So, in first row it is given that sales which is happening at the rate of rupees 10 per unit. So, the present sales will be 10,000 rupees of rupees 10,000 and expected sales will be 14,000. Now, if we will subtract variable cost, which is rupees 7 per unit. So, in first case we have variable cost of 7,000 and in second case it is 9,800. We get this value by multiplying 1400 and 7. Okay. After deducting variable cost from sales, we will get the value of contribution, which is 3,000 in present scenario and 4,800 in expecting scenario. And when we are deducting fixed cost from this, we will get EBIT, which is rupees 2,000 in first case and 3,200 in second case. So, the change in EBIT from present to expected situation will be 1,200, because EBIT is increasing from 2,000 to 3,200, whereas the change in sales will be rupees 4,000, because the sales will be increasing from 10,000 to 14,000. Using these values, we can calculate our operating leverage, which is equal to 1,200, which is change in EBIT divided by original EBIT, that is rupees 2,000. This whole value will be divided by change in sales, that is 4,000, which is further divided by rupees 10,000, which is our present scenario sales. Using this, we have calculated our operating leverage, which is 1.5. Okay. Degree of operating leverage may also be calculated by using this formula, wherein we can divide contribution by EBIT. Okay. Using the same example, we have calculated this contribution of rupees 3,000 and 4,200 in the previous example itself. Okay. And we have deducted the fixed cost from this, which is 1,000 in both the cases. We get the EBIT value, that is 2,000 and 3,200. This is the same example that we are discussing so far. By using this, we can calculate our degree of operating leverage using the formula of degree of operating leverage, which is contribution upon EBIT. So, our degree of operating leverage will be equal to 3,000, which will be divided by 2,000 in first case, that is 1.5, and 4,200 divided by 3,200 in second case, which is 1.31. So, this is how we can calculate our degree of operating leverage. From this calculation, we can see that whenever the percentage change in EBIT, which is resulting from a given percentage change in sales, is greater than the percentage change in sales, the operating leverage exists, and the relationship is known as degree of operating leverage. So, as long as our degree of operating leverage is greater than 1, that means we have this operating leverage, that means we are able to utilize our resources in a proper manner. There is a situation, we call it break-even point. So, whenever there is a break-even point, the degree of operating leverage cannot be defined, because in both the cases the amount, the value will be same. There are certain things we need to remember while we are dealing with operating leverage, that is, operating leverage is percentage change in EBIT as a result of 1% change in sales. So, whenever your sales is changing 1%, how much your profit is changing, this is defined with the help of operating leverage. Operating leverage arises as a result of fixed cost. So, fixed cost is the variable which is impacting operating leverage the most. So, if there is no fixed cost, there will be no operating leverage. Okay. Higher the fixed cost, greater will be your operating leverage, and larger would be magnifying effect of change in sales on change in EBIT. Positive degree of operating leverage means the firm is operating at a level higher than break-even level, and both EBIT and sales vary in the same direction. Whereas, when we are talking about negative degree of operating leverage, it means that the firm is operating at a level lower than break-even level and EBIT will be negative in that case. A firm should avoid operating under degree of operating leverage. Higher the degree of operating leverage, higher will be the risk. That means, higher degree of operating leverage is very risky for a firm. A firm should try to maintain sufficiently higher degree of operating leverage than break-even level. Okay? So, this is our operating leverage. Let us move to the next type of leverage, that is financial leverage. Financial leverage is the use of fixed charge on sources of fund. Fixed charge here means the interest that we have to pay for raising the funds from debt. So, examples of this debt may be the amount that we have borrowed in terms of loan or maybe the preference capital. This is done along with the owner's equity in the capital structure. So, owner's equity is already existing, but additional fund is raised from debt or preference capital, and this is described as financial leverage when we are able to utilize debt for getting the desired outcome. This is also known as gearing or trading on equity. So, the financial leverage employed by a company is intended to earn more return on fixed charge funds than their costs. For calculating financial leverage, we may use this formula where our degree of financial leverage may be equal to percentage change in EPS, that is earning per share, divided by percentage change in EBIT, that is earning before interest and tax. Okay. This may also be calculated by utilizing the formula which is given on the lower side of the screen, that is change in EPS divided by EPS, and the whole value has to be divided by change in EBIT divided by EBIT. Okay. Now, if we want to extend the same example that we are discussing so far for the leverage, we will move ahead from EBIT part. Our EBIT was 2,3,200 in the case of 1000 units sold and 1400 units sold respectively. There is no interest. Tax is 50%. So, 50% of 2000 is 1000 and 50% of 3200 is 1600. Okay. Our earnings after tax will be 1000 and 16,000 in both the cases. The number of shares in our capital structure are 500 in both the cases. Our EPS will be EAT divided by number of shares, that is rupees 2 in case 1 where we are selling 1000 units and 3.20 in case 2 where we are expecting to sell 1400 units. Okay. So, if EBIT has increased by 60%, EPS has also increased by 60%. Okay. This is the scenario when there is no interest that we are paying, no debt in our capital structure. So, if a fixed interest charge is not there, the change in EBIT and EPS will be absolutely same. Now, let us try and see that how the presence of debt in our financial structure impacts our financial leverage. Extending the same example, same sales 1000 in present scenario and 1400 in expecting scenario, EBIT is same. Now, there is interest because we have incorporated or we are using debt in our financial pattern now. So, the interest is 300 in both the cases because we have raised debt of rupees 3000 at the rate of 10%. So, in both the cases, in both the columns, we will deduct 300 rupees as interest from the EBITs. We will get earning before tax after deducting interest from EBIT, that is 1700 in case 1 and 2000 in case 2. Out of this value, we will deduct tax which is given at the rate of 50%. So, 850 in case of 1000 units sold and 1500 when we are expecting to sell 1400 units. So, our earnings after tax will be equal to 850 and 1500 in both the cases. Number of shares which are given here are 300 in both the cases, and our EPS will be rupees 3, approximately rupees 3 in case 1, but rupees 5 in case 2. So, the increase in EBIT is 60%, but the increase in EPS will be approximately 66.67%. So, this shows the impact how the presence of debt in our capital structure is impacting our EPS. So, the percentage change in EPS is higher than percentage change in EBIT. Using this, we can also calculate the degree of financial leverage, which can be calculated by using this formula, that is EBIT divided by EBT. We are using the same example for calculating degree of financial leverage. EBIT is same 2000 and 3200 in both the cases. We are deducting interest, which is 200 in both the cases. Profit before tax will be 1800 in case 1 and 3000 in case 2. Degree of financial leverage will be equal to 2000 divided by 1800, that is EBIT divided by EBT. So, it is 1.10 in case 1 when we are selling 1000 units, and it is 1.06 which we got by dividing 3200 by 3000 in case 2 when we are expecting to sell 1400 units. Okay. So, there are certain things that we need to take care when we are dealing with financial leverage. So, the financial leverage is the percentage change in EPS as a result of 1% change in EBIT. So, how our EPS is reacting when our EBIT is changing, this is defined with the help of this leverage, we call it financial leverage. The financial leverage emerges as a result of fixed financial cost. So, if there is no fixed cost, there will be no financial leverage. Fixed cost here we mean is interest, and the higher the fixed cost, the greater will be our financial leverage, and the larger would be the effect of change in EBIT in change in EPS. Also, there may be positive or negative financial leverage. So, positive financial leverage means that the firm is operating at a level of EBIT which is higher than financial break-even point, and both EBIT and EPS will vary in the same direction as EBIT is changing. Whereas, when we talk about negative financial leverage, it means that the firm is operating at a level lower than the financial break-even level and EPS will be negative. Okay, this is how we define our positive and negative financial leverage. Moving ahead to the third type of leverage, we call it combined leverage, or this is a stage where we are combining our financial and operating leverage. Okay. So, operating leverage affects a firm's operating profit. Operating profit here we mean EBIT, while financial leverage affects profit after tax or earnings per share. So, this is what we have seen when we have discussed the examples or the numericals dependent upon financial and operating leverages. The degree of operating and financial leverages are combined to see the effect of total leverage on EPS associated with the given change in sales. So, when we are combining this, so basically when we have begun our lecture, we have seen the two tables. In first table, we talked about operating leverage. In second table, we talked about financial leverage. Now, when we are combining these two tables to make it one table, we are starting with sales and we are ending to EPS. So, when we are combining this complete table, when we are combining our operating and financial leverage, we are able to see the combined effect of these two leverages on our financial performance, and this combined effect is known as combined leverage. Just like we have calculated our operating and financial leverage, we can also calculate the degree of combined leverage. As I just now mentioned, combined leverage is combination of our operating and financial leverage. So, degree of combined leverage can be calculated by combining or multiplying the values of degree of operating leverage and degree of financial leverage. So, from the equation which is given on the screen, you can see that on left hand side where the equation is starting, we have this this equation that is starting here, and we have this first part of the equation wherein change in our EBIT is divided by change in sales, which represents our operating leverage. This will be multiplied by the second part of the equation, that is percentage change in EPS divided by percentage change in EBIT, which is our financial leverage. So, these two parts are multiplied together and we will get the value which will be equal to degree of combined leverage, which will be equal to percentage change in EPS divided by percentage change in sales. You can also see from left hand side, if we will strike off these two parts, change in EBIT in numerator part and change in EBIT on denominator part, the ultimate leftover part will be equal to the same value which is there on the screen, that is change in EPS divided by change in sales. So, this shows the combined effect of our operating and financial leverage, that is degree of combined leverage. This may also be calculated. One way of calculating this is we can use the formula, we can put the value of EBIT, sales, EPS in the formula to calculate the value of combined leverage. Another way is we can calculate operating leverage and financial leverage. We will multiply these two values and we are able to get the value of degree of combined leverage. So, degree of combined leverage can also be equal to degree of operating leverage multiplied by degree of financial leverage. Okay. So, this is about these three types of leverages. So, when we are combining the effect of these three types of leverages, we can see that how it is going to impact the financial decisions, the financial performance of the company. Okay. So, you can see the table which is visible on your screen, wherein we have in first column operating leverage, in second column how the financial leverage is there in the company and how it is going to impact the company. So, in first case, when our operating leverage is very high and also the financial leverage is very high. So, this is the situation where we are facing the maximum risk, that means the situation is very risky. This is the case where we have high interest outflow not commensurate with earnings. Okay. Then we have the second case where our operating leverage is very high, but the financial leverage is low. So, this is the case which impact the company in this way. In this case, the sales are unsatisfactory as compared to the fixed cost to be absorbed. Long-term borrowings, not a strain on earnings. So, this is the case and the impact on the financial performance of the company. Then we have the third case where our operating leverage is low, but the financial leverage is high. So, this is the ideal situation for profit maximization, where our operating leverage should be low, right, because in this case we are able to reduce our fixed cost, and financial leverage should be high. Okay. So, this is the ideal situation wherein a company can maximize its profit. There will be fourth case when both the leverages are low, operating leverage is also low and financial leverage is also low. So, this situation creates a caution situation for the management. Management needs to think about this situation and they should take appropriate decision to reach to the third situation where our operating leverage can be maintained at low, but financial leverage should be high. Okay. So, this was about leverage analysis, okay, where we have discussed that what is leverage, what are three different types of leverages, okay, and with this we have successfully covered the key aspects of leverage analysis. We have discussed the importance and its impact on financial performances. We have seen this with the help of practical examples. Okay. We have seen the example of operating leverage, we have also seen the example of financial leverage and its impact of operating and financial leverage on combined leverage, okay, and how it is impacting the financial performance of a company. We have explored how operating and financial leverage and combined leverage play a critical role in assessing risk and making strategic decisions. So, before we move ahead to the next topic, the topic that we are going to discuss today will be EBIT and EPS analysis. Let us take a short break to refresh ourselves, okay, and I will see you after this break. Thank you for now.